The bull flag, a sharp rally, a tight pause, then continuation, one of the cleanest swing setups there is. Let me show you how to trade it the Confluence way. Every bull flag has three parts, and you can see all of them here. First, the flagpole, a sharp, near vertical rally that shows aggressive buying. Then the flag, a shallow, orderly pullback that drifts slightly against the trend while the market catches its breath. And finally, the breakout, where price pushes back through the top of the flag and the trend resumes. Pole, flag, breakout. If you can spot those three pieces, you can trade this pattern. Before any setup becomes a trade on this channel, it has to clear the Confluence stack for signals that must line up. The bull flag is special because it satisfies all four at once. The flag is the price action structure. Its upper edge is the key level. The volume and RSI inside the pause are your momentum read. And the breakout candle is the trigger. When a single pattern stacks all four, that's a high conviction setup, not a guess. Start your scan with the flagpole. You want a strong, decisive move higher on expanding volume. Watch the volume bars swell as price drives up. That volume is the tell. It means real institutional demand, not a thin drift. A weak, low-volume rise makes a weak flag, and the bigger and cleaner the pole, the larger your measured move target will be later. Now the flag itself. After the pole, price should pull back gently, a tight channel drifting slightly down or sideways like this. The single most important clue is volume. Notice how it dries up through the consolidation. That's exactly what you want. Falling volume on the pullback means sellers are exhausted, not aggressive. If volume surged on the pullback instead, that would be distribution, and the flag would be a trap. The flag hands you a precise, objective level, the upper edge of the consolidation, drawn across its lower highs. This is your line in the sand and your trigger location. Below it, the stock is still resting. A decisive push above it is the market telling you buyers have taken control again. Marking this level in advance removes the guesswork and the emotion from your entry. Momentum is your third Confluence signal, and the cleanest read is RSI during the pause. In a healthy flag, RSI cools off but holds above 40, the highlighted zone here. That tells you the trend is resting, not reversing. But if RSI rolls under 40 and keeps sliding while price drifts sideways, momentum is genuinely leaving, and that so-called flag is far more likely a top. Same shape on the chart, opposite outcome, momentum is what tells them apart. Here's the trigger. You want a candle that closes above your flag level, ideally on a pickup in volume like this surge. The key word is closes. Intraday wicks above the line trap eager traders and then snap back below. By waiting for a close above the level, you let the breakout prove itself, and you enter as the continuation actually begins, not on a head fake. Now define the entire trade before you click. Your stop goes just below the low of the flag. If price falls back there, the pattern has failed and you want out, small. Your target comes from the measured move. Take the height of the flagpole and project it up from the breakout point. That's an objective, chart-based target. Because your risk is the small flag and your reward is the full pole. A clean bull flag often offers 3-to-1 or better. Let's prove this isn't just theory. This is real NVDA daily price as of this week. Walk it left to right and you'll find the same anatomy, a strong pole, a quiet pullback on lighter volume, then a breakout that carried for days. The synthetic chart teaches the shape cleanly. The real chart shows it pays out on an instrument you actually trade, on the daily time frame a swing trader holds. That's the bull flag, the Confluence way, a high volume pole, the flag's edge as your level, momentum resting, the breakout as your trigger. For signals, one trade. Subscribe for the full method and always trade your own plan.